Very good evening, everyone. Welcome to Admiral Markets. My name is Chris, and Nenad is with us as well. Together, we're going to take a look at market cycles. That's the topic, the webinar topic of today on this 22nd of October. Before we dive into the topic, though, be aware that this webinar is intended for a global audience, but may not be suitable for everyone. Therefore, take a look at admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity to find out more information on that and other conditions and details. Also, be aware that trading for exchange and global financial markets in general is considered high risk and may not be suitable for everyone. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risks involved when trading. Alrighty, so once again, webinar hosted by Admiral Markets, admiralmarkets.com. You'll find out a lot of good information, analytics, webinars, as you probably know. But just in case later on, if someone's watching the recording, you can find out webinars and information about the Supreme Edition, for instance, as well. A lot of good stuff you can find and information. And Supreme Edition, a lot of great advantages, such as, for instance, a sentiment trader, a correlation trader, matrix, and the Admiral Markets in general, of course, offering a lot of interesting things, great spreads, negative balance protection, SMS service for free. So yeah, a lot of good things. So take a look at that after the webinar. All right. So today's focus, we're going to take a look at market cycles. And of course, a market, of course, could be a financial market. That's what we're going to focus on, of course, in today's webinar. And the cycle is something of a repetition in a way. It's a repetitive circle or some shape that comes back over time. So we're going to take a look at the cycles of stages. You know, what types of market cycles do we see in the various financial and economic markets of our day? So we're going to talk about that, and then I'll pass it over to Tarantula, and he's going to share his view on the topic. Of course, if you want to ask anything in the meantime, the chat is available, and I'll get to that when I see it. So basically, markets complete a cycle of stages, right? So for instance, in the diagrams, in the graphs there below, you're going to see a typical market cycle of optimism. We've shown this one before, something similar, where basically the market sentiment maybe perhaps gets more excited, then starts to drop, reaches a low point, and then starts to rise again, right? In this case, often enough, when there's a lot of excitement, one has to be very careful because there's a lot of risk involved, although seemingly it seems like a perfect moment. There's actually low opportunity and high risk in the blue box. Whereas when the market is actually going to the downside and bottoming out, perhaps there's actually less risk and higher opportunity. All right, but that's in any case the explanation of the graph. Of course, always be careful with trying to pick a bottom, I would say, but that's just a simple model. So now on the right side, we see a market cycle more tailored to perhaps the economy, right? With the recession, recovery, expansion, and contraction. Economy always making kind of these ups and downs. And we'll talk about that later on as well. Cycles, what could they be influenced by? Probably a lot of things, but certainly psychology, the economy, and maybe some other random things like even presidents. And I mean, if you look into this, you can see a lot of potential correlations. Whether they really hold true and for how long is a major question. And of course, it's always good to test these things and see if they've been tested. And that there could be a lot of randomness, a lot of coincidence in these cycles. So it's obviously something that if there is a cycle, doesn't mean that it has to hold true. But it's always interesting to look at both cycles that have been tested and not tested. All right, let's talk about psychology first. And this is something I thought was an interesting way to view psychology and the attitude of the market during those phases. And on the left, this is maybe more for the stock market, really. On the left, you see basically, they call it here the stealth phase. Price is really hanging around the mean, hanging around what we consider to be the average. And eventually, that's maybe where smart money is positioning themselves in that particular cycle. Then you see a takeoff. Institutional investors become aware, small kind of sell-off as price makes a bit of an upside. We're right here in the graph at the moment. And then with the media intention, the price starts to make a grand upside, and the public, the general public, the wider public, starts to catch on with enthusiasm, greed, and yeah, basically an expectation of a ever continuation of this upside. And very good example, obviously, is the dot-com bust, where in 90s everyone was buying tech stocks, or at least that's what I've heard. I was myself a tad too young for that. I was 19. Well, not maybe the age where you're the biggest stock buyer, but yeah, I did read about it, and yeah, there was a lot of interest, and everyone was talking about it. Even someone's grandma was warning them of the potential to buy stocks in the tech market. So yeah, if there's so much maybe buzz about it, it's easy to go with the flow and jump on for the ride. But you definitely want to be careful if there's too much talk about it. And of course, we know that it indeed was climbing and climbing, that market, and eventually just topped out and fell very hard, very similar probably to something what we see here, and kind of falling very quickly. So it's an interesting diagram or graph here where you have a bull trap, people saying that there should be a return to normal. What is normal? Well, apparently that big upside, of course, it's not normal, and then actually the big fall, and then eventually a return to the mean. So yeah, a lot of these cycles are like that. Gold, for instance, big bull run. Oil, do you see the similarity as well? Certainly do. The oil run, obviously, as well, similar, something in 2007, gold in 2011, very similar kind of movements here. So not only stock market, and we will see also very enthusiastic moves in the forex market too, that perhaps resemble such a big up and downside, but maybe forex is not the best example because it happens more often. This is, this gold that happened once it took, we're talking about decades for this move to happen. Forex market, these ups and downs happen a lot more. I think there's also a bit different psychology behind it. I'll show that at the end. Yeah, but these moves, of course, happen in the Forex market too. It's just that they happen more often, and it's not like I would say that the public is really talking about the euro dollar going up on the 15-minute chart this day. Obviously, that interest is not there. So it's a bit different from that point of view as well. From a psychology point of view, and wave theory explains psychology, market psychology, and tries to show a method of analysis how you can use the wave theory to tackle market psychology, understand it better, know where their opportunities could be. And I think it's a very, very valuable method of analysis. It's difficult. Yes, at the beginning, certainly. It will never be a precise 100% thing that I know for sure. Prices in this particular wave, no, it shouldn't be treated, I think, like that either. But it does give a lot of background about the market psychology and what we could expect from price movements. And we will be a bit more, let's say, all-rounded in anticipating what could happen and being prepared for those movements. And I think we'll be a better trader if you trade discretionary at least. So market cycles, they move in waves of 1, 2, 3, 4, 5. Those are impulsive, corrective ABC. I'm not going to dive into the wave theory today. I just want to say that it is a market cycle. We've had webinars at Admiral Markets, so you can take a look at the YouTube channel and go to Admiral Markets YouTube channel and you'll find wave theory webinars. But yeah, that's just wanted to give you the awareness. Now, obviously, a good example of someone who very practically and usefully capitalized on the wave theory is Paul Tudor Jones, who predicted the market crash in 1987 of the US stock market using wave theory and time factor, because he was measuring really literally the how far the market already was in its climb up to the crash compared to the Great Depression crash in the end of the 20s. So using wave theory, he was able to make that prediction, made a lot of money on it, very impressive, and made a big name for himself as well in a way, and placed his mark on the trading history, in fact. So you can see it's very valuable, very interesting part of the market cycle as well. We got economic cycles too. Economic cycles, I'm going to go a bit through economic cycles, by the way, and then go to Forex cycles, just that you're aware, and then it's going to take over. All right, so you have an idea. Economic cycles happen, you got basically in various ups and downs, as I already talked about, booms and busts, as economic activity expands and contracts, and it's always this kind of motion in a way. You're not really going to have a couple of decades where this is flat. Somehow it doesn't work that way. Policies that we do have impact and make the economy go up and down in a way, and for whatever reason, this is the motion it makes. That's a cycle. We got smaller cycles within those bigger cycles. So, for instance, here you can see they're talking about an 80-year economics cycle, where in the 60s there was innovation, the 80s and 90s and 2000s there was a lot of upside there was a big growth, all right, but there was a bit less innovation perhaps. Last few years we've been in a more negative territory where we're spending less and also even less innovation, low inflation, deflation kind of environment. And then they expect maybe at the end of this decade, again, a boom up where there's a maturity boom, as they call it, not a growth boom. So maybe one more push up, not as big as in the 80s, 90s, 2000s. Prices will go up a bit, innovation will go up, spending will go up a bit, and then they expect kind of a recession again. So you'll have these ups and downs. Some growth will be bigger. They call this an 80-year cycle. You can make a lot of models. It's just one of those. And here, just maybe a bit more, about that up and down. There's always phase, basically, as you probably know, recovery phase, early upswing phase, late upswing phase, and then a recession and slowdown. And the markets are characterized by different elements of that. With the early upswing, you got increasing confidence, stock markets are strong, commodities are strong, whereas when the economy is entering a recession, confidence is dropping, inflation is perhaps still continuing to rise, but we see the stock market falling, we see commodities already falling, we see already that impact of a downside. And then the recession hits, obviously, inflation peaks, goes down, because inflation goes down to, the interest rate, peaks up, it goes down because they want to spur the economy. And you see the stock market bottoming. So you see the cycle. I won't go through all these points, but it's a typical cycle of enthusiasm, cautiousness, etc. So as I said, you have these ups and downs. Really, within a few years, you'll have a smaller cycle already taking place, right? In the 2000s, we had dot-com bubble. 2003, things were already up, at least in the US, up and going up again. That lasted for 4 years to 2007. 2007, there was already some overheating, some problems already visible. 2008, the crash came. 2009, followed through. 2010 started to climb up a bit, right? So you can see that that was just one of those cycles. Now, if you look back at 50 years, you're going to have more of those ups and downs. If you look back at 200 years, you're going to see a lot of those ups and downs. And then you can maybe start to group more phases together. And maybe not only look at economic ups and downs, but add a bit of a technology into it. And you might get these Kondrativ wave. And it's also a cycle kind of phenomenon in the modern world. And it says basically that industrial revolution was a starting spot, then moved on to a cycle of steam and railways, steel and heavy engineering, then into oil, and lately into information and telecommunications. So, obviously there have been lots of ups and downs from 1971 onwards, but from this point of view, from 1971 to now is one big wave, and then we've had smaller waves in between, right, in that period from 71 to now, with some problems in the 70s with regard to inflation, economic upside in the 90s, then a stock market boom and bust in 2000, and upside again, and then downside, with these ups and downs within that. But then you can group it together. And if we go maybe even back further, this is 1970, 71, maybe a bit further even, you could even say, you could group it maybe a bit differently: financial, agricultural revolution, industrial revolution, technical revolution, scientific, technical, information, and who knows what the next one could be. I'm sure that there are some thoughts about that, but time will tell. In the graph, you can see all the kind of prices. Actually, the red are prices of the US, wholesale prices, and you can see all the events that are connected to wars and recessions. And if you would plot all those points together, prices have been going up and down and have been basically spiked to the upside when there's war, kind of maybe in a way stimulating sometimes the economy. The economy, like, well, the U.S. economy got indeed stimulated during the Second World War, for instance. Now, that is perhaps a pattern or a cycle as well. And you can look at many cycles. You can look at the fact, and I'm sure the more data you go back to, right, the bigger groups of cycles you can get. Like this example. Stock market cycles. This book basically talked about various cycles in the stock market, something called the 4-year presidential cycle, where the third and fourth year stock markets do a lot better of the U.S. do a lot better when the U.S. president is in the third or fourth year than the first two. Whatever the reason is, maybe the uncertainty connecting to the switch or the elections. Difficult to say. I would say we probably have to read the entire book, but and read it again. But this is something that has been observed and is an interesting aspect. Also, something that you probably know is the annual seasonality. Sell in May, go away for the rest of the summer kind of stuff. Market going very strong in January, the January effect continuing pretty strong until May, and then kind of having a downside. And there are other things perhaps as well. Even the moon effect has been studied, and stock market in terms of time frames as well. All right. The economy is also connected to the business cycles. They're not really in sync. You got the stock market and the economic cycle, and the stock market is a bit ahead. So that first wave up here, you can see that's the stock market, and the economy could be already actually still in problems and going up way later, but the stock market is typically ahead of that. And then the stock market is again ahead when it starts to fall, but the economy hasn't really peaked as yet. So it's kind of like an early indicator, in fact, of what the economy probably will be doing. And different sectors are interesting during those economic phases and stock market phases. When the stock market is on the early side of the bull, uh, common wisdom here is that transportation and financials are good. Why? Because typically transportation starts to pick up, so they're the ones who notice that first. Financials are basically see an economic activity expanding slowly but surely. They'll pick up the fruit of that at the beginning. Then technology, then capital goods apparently, then basic industry, and it continues as the cycles continue. Other sectors become interesting, and last but not least, utilities are good at the when economy is going down or peaking, because then people always need food, people always need their basic elements, their basic kind of their in the West, of course, we have our electricity. I mean, we have our standard kind of consumption that even in bad times is mostly used. And we might push away the car, the yacht, and stuff like that because it's tough times, but you're still going to buy, and in most of the world, you're still going to buy the food and consume the energy the basic energy perhaps that you need. So utilities, therefore, consumer cycles, cyclicals are in demand. And here you can see a standard business cycle of about 4 years, right? From transportation to technology, services, capital goods, all the way down to those consumer goods. Now here, financials are actually late. So in any case, basically financials are better when times are not necessarily booming, but it's either showing a turnaround, right? And connected to that, you can see also not only the sectors here, but what's happening in the economy at the time, from rates falling, stock markets going up, inflation rising, down to properties falling and inflation falling. So where are we now, perhaps? Well, it says 4 years, but this is, of course, maybe typical 4 years. But of course, as you know, things have fallen a lot in 2008, 2009. We have had some up and downs as well since then, but not very sturdy recovery. So while stock market is certainly be up, but have we had economic recovery? Doesn't look like it. So we're probably stuck somewhere in here. Somewhere where short-term rates are still actually flat. Stock markets are up, yes, but the economy does still look so-so. There are some signs of upside. I'm talking about the US now. Europe definitely looks weak still. Japan looks weak. China, well, also probably has some problems at the moment. Yeah, so from 2008, 2009, there was not really a lot of expansion above this beginning zone, I would say at least. All right, and obviously 2002 to 2007, things went a lot more speedier here. They went through these phases a lot faster, hit the inflation indeed within those 4 years probably, and then 2008, 2009 started to make that tumble down. And the last 5 years we've been more stuck here. And this is something like that. 2002, 2007, 2008, 2009. So sometimes those years can vary. All right. Now when we look at the economic cycle, when we look at the stock market cycle. Of course, stock market is just one thing. As an investor, you might want to consider stock market, but maybe not. Stock market has its cycles. The business has its cycles. Stock market is a bit of ahead of the business cycle, as we know. But what will you want to do as an investor? An investor might want to invest differently. The stock market might be in a certain cycle. It doesn't mean that that's necessarily the only thing we can invest in as an investor, obviously. No. So this graph is combining interest rates and economic cycles, and then kind of showing the balance of an investor. The ideal may be balance. For instance, if the economy is slowing down and interest rates have peaked, then it could be good to go from cash slowly but surely into bonds, as you can see, right? Because the interest rates, well, actually, I should say when the interest rates get higher, obviously, you want to go into those bonds. You can see that this space here is getting bigger. So when interest rates go up, obviously, you want to capitalize that a bit and move the cash basically into bonds and maybe into some stocks, as you can see, financials apparently. As the interest rate peaks and the economy goes from slowdown to recession, you want to go away because the interest rates are going to be falling to spur the economy, and you want to move into stock markets there in financials. And as the recession maybe takes a bit longer and slowly shows a bit of signs of improvement, there is a chance to go into other sectors like consumer, commodity shares, because then in that case we're already starting to see signs of recovery and interest rates have bottomed. So we can go into equities and try to catch the tailwind, or not the tailwind, but yeah, the tailwind, yeah, the push of the economic recovery in the stock market. And the stock market is then going to rise, the economy is going to rise, the interest rates are going to rise, the interest rates are going to rise to slow down the economic expansion, otherwise inflation will go too high. We're going to get a boom, and then in that boom phase, at some point, the stocks should go down and they should be going to cash as a defense against the slowdown. Now that might still take some time because look at the S&P 500, it pushed. Last few years a lot more maybe, and if you do that too soon, you could lose out on a decent still push up. So that's always a difficult balance, but eventually it's going to be a boom and interest rates will start rising. So it'd be better to go into cash and then back eventually into bonds, and we made a circle. So I like this graph because it combines economic cycle, interest rates, and then says, okay, here, this is how you should invest. This is how you should invest. It gives them kind of the balance between those three things, between stocks, cash, and bonds. Of course, there are other things as well, but I thought it was an interesting graph to give a bit of a rough indication about the division of an investor, what they can think about. Combining interest rates and economic cycle, and the stock market cycle too. All right, last but not least, the Forex market obviously has its cycles too. What kind of cycles do you think? Well, in my opinion, market makes price action cycles of impulse and correction, in my opinion. That's the main cycle driver, I think. And it's basically, the bull upside, the bear downside, and then the consolidation, which could be called the distribution phase or accumulation phase, as you can see here. But it's all about impulse and correction, in my opinion. That's always a cycle that we see coming back in the Forex market. Up, down, and then we see impulse correction. Bull, bear, impulse correction. We got bullish impulse, bearish impulse. Bullish correction, bearish correction. Those patterns are always repeating. There's a cycle of that. And just like we see trends and reversals. So from that point of view, I would say that Market in the Forex is always about the average. Expansion from the average, move back to the average. An impulse from the average, an impulse back to the average. An impulse from the average, correction back to the average. There's this impulse and correction always around the mean. Maybe even more so than, for instance, a stock or the commodity. There they have means too, but I think maybe even more important in the Forex because we're looking at two countries in relationship to each other. Whereas if you look at a stock market, you're looking at a stock versus cash, um, which is the stock price, or you're looking at commodity versus a cash, right? So you're looking at the commodity price. Here we're looking at a relationship of two countries, which is a bit different, I think, therefore even more probably important, the average mean here and the movement around the mean and the expansion from it and movements back to it or impulse and correction. I think that's the primary Forex market cycle in my opinion. Um, and there are a lot of we just talked about a few cycles. In fact, if you dig deeper, I think that you can find a lot of repetition in the Forex market. That those are maybe patterns, right? Forex market patterns all over the place. But from a cycle point of view, I think that this is a very important one in my opinion. Well, that wraps up my 2 cents, and I'm going to pass it over to Nenad, and let's take a look at his presentation.
Thank you, Chris. Lovely presentation. So I will continue. Uh, let's see. I need to switch my screen first. So market psychology, trader psychology, and market cycles. So those are things which we will be talking about today. So Chris has already explained a few things about market psychology, but I will jump in with my opinion also, which is exactly the same as Chris, but I'll just give you a few examples. So basically, market psychology is an overall feeling among market participants. So that is how market participants are seeing the market in a given time frame. So we are usually thinking that if something goes up, it will endlessly continue to go up, and if something is going down, it will continue to go down. But that can be a problem. That can really be a problem if we don't know how to recognize when those impulse corrections or market phases are over and when there are some other things which also influence the market, and that is also called general bias. If you remember I will show you general bias is basically how market participants are feeling about some particular event, and there is a general opinion and consensus of what they think it will happen. So if you remember my interview from October 19 with Forex Street, this is a good example. There was a question: do you think the ECB will announce more QE in their next meeting on Thursday, or at least this is crucial, will Draghi talk down the euro? Now this is very, very crucial because I mean, that was my presumption, that there will not be more quantitative easing. But the thing is, Draghi is always talking down the euro. So that is another way to basically weaken the currency. So what I said is, to be honest, I'm not sure that ECB will go further easing on next meeting, okay? But this is also important. Weakening exchange rate can also happen in a different way during news conferences when third parties, also known as investors, act as a ECB conduits, effectively causing the euro sell-off due to different QQs and dovish Draghi. So dovish Draghi was a conduit for a general bearish sentiment over euro. So what I also said is my outlook for euro dollar is still bearish. That is general bias. Okay, that is general bias. So I and market participants are generally biased that euro dollar is bearish. but we should be prepared for possible rally short term. So that means that we have been buying euro until today. There were a couple of rejections from 1.3010, 1.1330, and all those rejections were basically happening at our point of confluence. But today, mid-term bias prevailed over short-term bias, giving us basically selling strength. And that selling strength now is pushing the exchange rate towards 1.1100 support. So that is a general bias of the market. That is market psychology. You always need to be in accordance to general bias of the market. Now, there is also so-called investing mentality or investing sentiment. That is important, guys, because investors basically also move markets. And I'm not talking about retail investors, retail traders. I'm particularly about huge investors, huge fund managers who are basically competing in these market conditions, competing with the market and between their own mentalities. Because sometimes you will see that there is an investor who thinks that euro dollar will go up, and based on that he or she makes a position in the market. Also, there are investors who are not thinking about short-term use. They are basically basing their analysis on general market bias or sentiment. So they are going short into euro. I, for example, as you can see, I am an intraday trader and intra-week trader making swing trades, but that is generally also considered, let's say, maybe a short term, right? So basically my mentality is short term, which always goes in accordance with the general bias of the market, which I read through price action. And it's important to say that market psychology is definitely intersecting with price action. Why is that important? It's basically very important because investors also fall in different traps. I can say that a lot of smart people make dumb mistakes with their money, especially during volatile times. And I really think so. So smart people making dumb mistakes during these volatile times. Why? Because they fall into certain mental traps. There is a market psychology trap which intersects with price action. What does that mean? That means that basically it's called hindsight bias. It's basically would, should, could syndrome. Okay, that means that that people, if something is going up, they think that it's going to continue to go up, and if it is going down, it will continue to go down. That's called cognitive bias, and that is basically inertia bias. And that inertia bias is making smart people to act dumb with their money. Okay? Because market has its own stages. Market has its own cycles. If something is going up, it doesn't necessarily mean that it will continue to go up. It will continue to go up, but after it made a dip. That's why I'm teaching you, and Chris also, we are teaching you how to trade institutionally. Do not trade as retail herd. Trade as institutional traders. You need patience for that. Okay? You always need patience. So for a proper trading, you need to be patient. So you need to buy a dip or you need to short into a rally. Of course, going with the general bias and general sentiment of the. So what I'm implying and what I'm trying to say, market psychology will always intersect with price action. Okay? And do not fall into cognitive bias trap, because it will really have a negative impact on your account. That will put you into an emotional roller coaster, which you don't want to fall into. This is the roller coaster of investors' emotion. Optimism, excitement, and euphoria is at the top. Okay? Now, we know, guys, from our previous webinars that point of maximum financial risk is at the top when you are euphoric. So your emotions while trading should be always in between optimistic and thrilled. Because when you start to be euphoric, that is the time when you fall into a hindsight bias, or what I said, woulda, shoulda, coulda syndrome. Do not let that happen. Because if you let it happen, you will definitely start to fall down in a roller coaster ride, which can be very, very stressful. So never ever allow yourself to fall into those kind of traps, because if you do that, it will be very hard to manage your account to the upside again. So be realistic. Be realistic, okay? Try to be always optimistic. Do not fall into a roller coaster, and be long on emotions, okay? Long on emotions. This is a market chart of human emotions. So you always want to start, as I say, hopeful, optimistic. And you see, guys, just compare these charts to your emotions. Now compare these charts to your price action. You are going long on support, and you are basically exiting at the top. Okay? So you don't want to be short on your emotions. You want to be long on your emotions. You see, from hope through optimism, belief, thrill, ending at euphoria. When euphoria hits, that is your ultimate resistance, you're exiting the market. You don't want to be short on your emotions, because it will be disbelief through hope, optimism, and finally, guys, finally, if you cross this boundary here, you can go into a spiral of doom. So always try to be positive and long on your emotions. Okay? This is, okay, a Bitcoin hype example. You probably remember Bitcoin hype. Even some of people who I know, some people who I know are really who don't have a clue about trading. They were trying to trade Bitcoin by buying, I don't know, expensive PCs and video cards. It's called data mining, and it was a lot of things, bad things happened with this Bitcoin, which is basically a virtual currency. But you know, guys, there is also market psychology, because stealth phase was smart money. When Bitcoin was introduced, all those pioneers, basically, who knew about Bitcoin, they made excellent initial wins. And from stealth phase, we had institutional investors who entered basically, but they fell first into a bear trap, which was awareness phase. Then there was mania phase, and that is the time when Bitcoin got into media. But that was basically, you see, first there were a lot of investors and institutional investors and people who already made money. And when retail herd joined, then basically everything started to fall apart from this point. Media attention, enthusiasm, greed, illusion, and then back to normal fear, of course, bull trap and despair. A lot of people lost their money because growth demands a temporary surrender of security. Okay? Now, when people write the history of Bitcoin, they will not going to write the story of 6 million to a billion, because that is smart money. People are not aware of smart money. But what is truly remarkable is the story of 0 to 6 million. But that already happened, guys. That already happened. And while media attention was at its peak, it was already happening. Retail herd joined up, and basically they lost a lot. They lost a lot. So that is a cryptocurrency, a virtual currency. Okay? And what I wanted to say is basically that was the time when I also mentioned data mining. So Bitcoins are created through a process called mining, which happens to be the same mathematical process that seals blocks of neutral section onto the blockchain by verifying that every exchange is valid and using real bitcoins. That was misused because there were a lot of hackers who actually used their PCs to data mine other computers. And there were a lot of virus programs called data miners which exploited other people's PCs. Okay, so definitely pay attention to that. Blowout phase already happened. Now, I really, in my opinion, I don't do this, and I don't recommend you doing this, really. And we finally come to our famous trader psychology. You all know that. We already talked about it. Okay, from optimistic to euphoria. You exit here. You don't want to go on a roller coaster. This is same, guys, as if you remember our price action. It's basically inverted N pattern, you see, and that is bearish pattern. Okay, this is bearish pattern. 1, 2, 3. You don't want to fall into a trap of bearish N, inverted N, and that is why you should always follow this cycle of emotions. Trading psychology is market analysis, risk to reward, exit entry management, account strategy, and technical analysis. Everything is connected into your trading psychology. You don't want to be greedful, fearful. You want to be hopeful. You don't want to be regretful, because eventually it will lead you into that infamous spiral of doom. Okay? Do not fall into the trap. Market cycle basically is different to, of course, trader psychology and market psychology. It's a standard cycle of market behavior which has been repeating itself through all 20th century. Basically, those were Wyckoff working models, which Richard Wyckoff and Charles Dow incorporated into the well-known Dow Jones theory and Wyckoff theory. Richard Wyckoff was of the idea that a cycle was a direct result of institutional traders who planned their daily trading activity around exploiting the public lacks of trading sophistication and profiting. So because there is always that institutional versus herd mentality, he identified 4 main stages of market cycle. Those 4 market cycle stages are basically learned throughout the whole economic university, and those are accumulation, markup, distribution, and markdown. That is primarily the stock cycle, but it also applies to Forex market as well. Accumulation is basically the first stage, and it is expressed as a sideways trading range. And in that sideways trading range, large players buy carefully with skills so the price doesn't go widely and alert the public that something is happening. The stealth buying selling is very covered, and when pulled off successfully, the public is completely unaware that accumulation is taking place. But we can identify that in Forex market. Then there is definitely the best time for buying, because you're buying at the bottom. It automatically translates into stage 2, where we have markup or uptrend. The uptrend is where bulls are firmly in control and price goes up and down in a steady series of higher highs and higher lows. That is what I call a zigzag. The public usually enters the market, retail traders, at this phase and cause greater acceleration in price upward direction, where the smart money is already in a firm position and may take advantage of new highs to lock in profits, while the public or retail demand for the particular currency or stock is high. That is why we see distribution phase. Investors already lock in the profits, and now the herd is trying to push it upward, but well, guys, it usually stops short. But that is the best time for selling. Distribution phase is basically vice versa for accumulation, when we were buying here. Now this is the best time for sell. It was not. Now let me just stop at this point and let me show you the analysis of dollar yen. And that was a perfect market analysis, I need to say, because it actually explains what was happening. I will show you that in a second. So it was okay. Let me scroll through the site. Okay. Range-bound trading continues. Here I have identified that this was resistance. And basically, while this was the place to buy, after, of course, consolidation on lower time frames, this was the place for distribution. And if you remember what happened after the analysis, the price rate dropped to 190.60. I mark 190.40 as important level, but it went to 190.60. And after the news today, after ECB conference, the pair jumped, basically taking my target, which was 120.50 if you read the analysis. So the thing is, this was the place for a distribution. That was the place where you should sell, because that was the best time for selling, to profit actually from the fall. Traders who jumped in a little bit later, they were probably trapped into that I can say distribution phase, because after that we saw a little bit of consolidation. Check your charts. It was around 190.85, and then the price jumped again. That all could have been observed on 15-minute time frame. Next slide is actually showing you Euro New Zealand scholastic example of accumulation markup, distribution markdown. This was accumulation phase. You see sideways movement. And this was markup. At this phase, investors are already buying. Markup phase is where retailers are buying. Distribution phase is where institutional traders are locking in the profits and they start to sell. And look what happened. Scholastic example of accumulation, markup, distribution, markdown. So guys, what I am implying basically, that you should always be aware of that you as a retailer cannot move the market. Definitely. Market is moved by companies, by funds, institutional traders, and big banks. Okay? So stage 3 was distribution, I said. Now, a large part of the retail traders will buy here because they think that next level of resistance will break. It's not the case, because usually the price will start to decline because large players will sell their position and turn around short the market. The retailers get squeezed between these two types of actions, and they usually close their buy trades, thus accelerating downward movement. So markdown phase is a downtrend which follows distribution, and where some of the large players are basically covered these shorts. They are exiting the markets. Okay? But well, some of the traders are shorting here, effectively trapping themselves into two opposing forces of the market. That is what you should avoid. And that is why we are helping you with our analysis to actually differentiate between POC points, points where you should buy, POC points, points where you should sell. Because POC points are connected to institutional accumulation, distribution, markup, and markdown phases. Everything is incorporated in this. How long do these stages take usually? On longer time frames, it takes longer time. But don't be fooled, because even on shorter time frames, you can see that. I already showed you example of 15-minute time frame. So even on 15-minute time frame, which is intraday time frame, you can see accumulation markup, distribution markdown. Of course, institutional traders go with higher time frames. But you as a retail trader can and should be able to recognize it on intraday or intra-week swing time frames. Because market will always move in cycles. Always it will be buying, then it will be sideways movement, selling, then another leg of buying, or when there is a trend change, we go all around again. So guys, that was all. I hope this helped. If you have any questions, you can of course ask me. I hope that you enjoyed, because we already made some nice moves. We had good pound dollar trade setups, euro dollar, of course. We don't trade during ECBs. We can trade after ECB conferences. Everything was aligned, and basically now we know what we should do next week. Pay attention to this, what we were talking about today, and do not forget that you want to follow big players. You want to follow big institutional traders. You don't want to be a simple retail traders, because we are here to help you to trade as institutions do. Okay, I don't see any questions. So guys, I wish you a great weekend, and I wish you to, of course, apply for next set of webinars, because we will be having a lot of important webinars next week. Do not forget that we will have a session recap. We will also have live trading rooms with Chris, price action trading school, chart patterns, schematics, and all those good webinars. Okay, thank you guys. Thanks Caesar, Nat, everyone. We wish you great day and great trading, and do not forget to sign up and enjoy it. If you have any questions, of course, we're always here to help you, so don't forget to ask us if anything is not clear. Thank you. I wish you a great weekend and trade safe. Cheers.